Okay, guys, now we have to stop and get on with this stuff. Okay, so the important points that Sahil brought up is this is the important point. The first point is this. Okay, fixed coupon bond. Okay, so when I say that bond and loan pricing, so whatever I discuss with respect to, we have only discussed bond pricing. Okay, whatever I've discussed with respect to bond pricing applies to loans also. All right, and loans are usually, most of the loan pricing is on a floating rate basis. Okay, because banks are funding on a floating rate basis. Most of the loans are loan syndications are done by banks. Okay, and so this they basically fund on a floating rate basis. So they try to match it to a floating rate structure. Okay, so this is for floating rate debt. Okay. So now the benchmark. So the important point that Sahil raised, the first important point is that we have already talked to this. This is a nomenclature matter. This goes there. So I've already told you about the LIBOR scandal. So the important point that Sahil raised was that if it is, we are talking about an Intel FRN being priced at 2020, due 2020, a 10-year FRN being priced at 75 basis points over 3-month LIBOR. Okay, if you are saying that, then so what he's saying is, so where did the government benchmark go? Because LIBOR is not the government bond benchmark. Okay, LIBOR is only meant to reflect. LIBOR reflects roughly AA rated money center bank credit risk. Okay, so let's say LIBOR reflects credit risk of. Let me erase this. AA rated banks. Okay, so LIBOR reflects a AA credit risk. Okay, so what if the question that Sahil are asking is, if you're saying that an FRN is being priced at 75 BP over 3-month LIBOR, then what happened to that government bond benchmark? Okay, so the point is that where do you think the government bond for 3-month LIBOR? Okay, for the same period on the yield curve, the same point on the yield curve, there is a 3-month maturity. So do you think the government bond yield or the government bill yield for 3 months, the YTM on the government bill, the treasury bill, is that going to be lower than LIBOR or higher than LIBOR? Lower. Everyone is clear? Is everyone convinced that the government treasury yield? So if you're looking at US dollar LIBOR, the US treasury 3-month US treasury bill, the YTM on the US treasury 3-month the US treasury US 3-month treasury bill, okay, is it going to be lower than LIBOR or higher than LIBOR? Arihant is not convinced. Who is saying lower than LIBOR? AA. No, Giri. Why should it be lower than LIBOR? Use the mic. Give him the mic quickly. Practice fast baton relay techniques and pass the mic. Yes. Yeah, so why should the US 3-month treasury bill yield be lower than the 3-month LIBOR?
Because the yield will be less than compared to.
Voice is not coming through the mic. Okay, guys. Yes. Yes, yes. You're not holding it maybe close enough.
Hello.
Yeah. Yes. Still not gone. Okay, forget the mic. Just let's forget the mic because most of you are. I don't know why you have to be conscious of the fact that your voice is not coming through the mic. See, Vaibhav was able to speak through the mic. Sometimes 1 minute. Sometimes the mic. This is the part of public speaking that you guys should learn. All mics are not going to be configured the same way. You need to be conscious of whether your voice is coming through. If it's not coming, then hold it closer to your mouth. Otherwise, sometimes push it away. These adjustments you have to do on your own. Okay. So this is all part of your training. Okay, go ahead.
So the LIBOR will be higher as compared to the US government bond yield. Because
yes.
If the government bond yields are higher, then the investors who are seeking to invest their money, they will invest in the bonds instead of that LIBOR. So the private investors who are taking money from with the benchmark of LIBOR, then they will not be able to do that because
what you mean is not private investors, you mean issuers.
Yes, issuers.
Okay, so what he's saying, okay, your answer is, I understand what you're saying, that's a consequence of this being higher, but the correct way to answer this obviously is that because the government's credit risk is obviously much lower than any private entity, So if a private entity is borrowing at 3-month LIBOR at whatever percentage, X, okay? So if 3-month LIBOR is X%, then the government treasury bill yield has to be lower than X% because the risk is lower, the default risk is lower on the government bond yield, the government bill yield on the government treasury bill. So therefore, the return also will be lower. That is how you should answer it as a finance student. So you have to make this connection between risk and return. You have to say that private sector AA rated banks are borrowing at, these are private sector banks that are borrowing at LIBOR, and so since the government is a better credit risk than any other private company, private entity, so therefore the government's risk being lower, okay, therefore their return on a government debt security should also be lower. Is this clear?
Yes.
That's how you should answer it, okay, logically. Okay, so LIBOR reflects credit risk of AA rated banks. So I'm not going to write government treasury all the time. Treasury is understood to imply government. Okay, treasury bill yield, I'm just going to write YTM for yield. Okay, will be lower than LIBOR. Okay, there have been in the aftermath of the GFC and the abnormal monetary policy that has been followed, there have been some freak occasions where actually not in the money markets, but in the bond markets there have been some freak occasions where actually private sector, I mean interest rate swap rates have gone below, which is essentially a AA rated credit spread has gone below the total cost has gone below the government treasury bill. Okay, government treasury bond rate, but those are freak events. But theoretically, they should always be lower than LIBOR. Okay, because you understand why. Okay, risk return. I'm just going to write risk return here so that you remember the logic. All right. Okay, so this is the first thing. So therefore, now here this brings us to an important point, which is there's something called a TED spread. Okay, if you look in that book which I've given you, that risk management solution standard chartered book, you'll find a mention of the TED spread. You should know this. Okay, part of our coverage of debt capital markets, you should understand what a TED spread is. A TED spread essentially is, the TED stands for Treasury Euro dollar spread. Okay. Okay. Treasury Euro dollar spread. This is the TED spread stands for, let me write it here, okay. The TED stands for Treasury Euro dollar, okay. Now what is this Euro dollar? Remember that LIBOR is, we don't have the time to get into the detailed macroeconomics of Euro dollar deposits, but essentially these are deposits that are domiciled outside the country, okay. The currency of which is being, I'm not phrasing it properly, I need some time to phrase it out, but the point is the euro dollar deposits are deposits in currencies which are where the deposits are domiciled outside the country, okay, of that particular currency. Okay, so for instance, a dollar deposit in London is a euro dollar deposit. Yen deposit in London is a euro dollar deposit. Okay, this is clear to everyone? Okay, so the point is this entire big euro market that we have, this whole LIBOR business of which trillions of dollars of debt. Okay, the entire fixed floating rate debt market and the interest rate swap market will shut down if we get rid of LIBOR. Okay, without a proper replacement. So trillions of dollars of debt have been priced off LIBOR, and this stuff has been going on since 1980s, since the 1980s when the euro markets really took off. Okay, and huge amounts of money are raised. Okay, so capital raising, understanding the euro markets is very important, mainly centered in London, and there is some activity in New York as well, but mainly most of it is, the bulk of it is in London. Okay, so now what you have is this Treasury Euro dollar spread. So essentially, let's put it this way: LIBOR is, I'm just writing YTM all the time just to avoid having to write a big word like yield. Okay, so LIBOR is the YTM on euro dollar deposits. Okay, all right. So therefore, when we talk about LIBOR, it's the interest rate that is being paid on euro dollar deposits. So that means essentially 3-month LIBOR, 3-month US dollar LIBOR is the 3-month interest rate on a US dollar euro dollar deposit in London. Okay. Now remember when I taught you guys the initial taxonomy part of financial markets, I must have mentioned, I think you've forgotten, but I would have mentioned that whenever you're referring to this thing here, if you're referring to this thing here, this, okay, if you're referring to this euro USD, this is spot euro USD, spot FX. Okay, So that's why I told you that you should always never say euro dollar. If you're referring to the foreign exchange markets, don't just say euro dollar, say euro dollar FX. Okay, that is meant to distinguish, make sure that you're talking, I mean, make it clear that you're talking about the foreign exchange markets, because otherwise if you say euro dollar, you could be referring to euro dollar deposits. Okay, and there's a very important interest rate, the most important, probably one of the two most important interest rate futures contracts, which is the futures on the 3-month euro dollar deposits. Okay, so there is a very active treasury futures market, not treasury market, but a futures market in the US. Okay, on the CME, there's a contract called the 3-month euro dollar futures contract. Okay, which is where you bet on the level of the 3-month euro dollar deposit. Okay, so if you have a 3-month euro dollar futures contract trading for the March maturity, say a particular maturity in March, what you're betting on through that futures contract is what will be the fixing for 3-month euro dollar LIBOR in London on the 15th of March. Are you following what I'm saying?
Yes.
Okay, so there are some very important markets, which is the euro dollar deposit market in London. There is the very important 3-month euro dollar deposit futures contract in the US. So these are meant to be distinct. You have to mention when you discuss something like, when you use a word like euro dollar, you have to be very clear about what you're talking about. Okay, so therefore, to avoid confusion with these other interest rate contracts, which are also called euro dollars. Okay, when you talk about the foreign exchange markets, you should always say euro dollar FX. Are you following what I'm saying? Why I'm saying this? Okay, all right. So where are we now? So LIBOR is the ITM on the euro dollar deposit. Now the TED spread, okay, this is a term that you need to be aware of. You can refer to the, I'm just writing this RMS. Okay, you can find out where the page is, which page number it is. You can do some, even if you do some searching in it, it'll be good for you, because all those instruments are still valid. Everything that has been described in that book, okay, is still valid. Okay, now the LIBOR is so here what we need to understand is there is another aspect that we have to look at, which is the interest rate swap market. Okay, what I will do here is that okay, so let's put this as so the TED spread is basically a general term for any kind of difference. Okay, so a TED spread, first let me write it this way, that a TED spread is a species, not correctly written, okay, is a species of credit spread. Do you understand that? Based on what I have told you now, based on what I've told you as to what the TED spread is, the TED spread is this difference between the euro dollar interest rate, okay, the interest rate on euro dollar deposits, okay, and the US Treasury, okay, yield, the US Treasury yield for the same maturity. Okay, so whenever you're discussing TED spread, normally we are referring to the 3-month maturity, but you could be looking at 9 months also or 12 months also. Okay, so you can specify that. Okay, but normally we are talking about the TED spread at 3 months, but in the name itself, there's nothing that ties you to a particular maturity. So the TED spread is merely the difference between the yield on 3-month on euro dollar deposits and the treasury, the comparative, the corresponding treasury yield for that maturity. Is that clear? For the treasury bill yield or the treasury security yield. Okay, so can you see that it's a species of credit spread? Because what is LIBOR, euro dollar deposits? LIBOR is referring to what grade of credit risk? Double A, right? So if I'm subtracting, if I'm telling you that the TED spread at the 3-month period, the TED spread is say 45 basis points. That means the double A yield, the double A yield for double A credits, okay, the yield for double A credits is 45 basis points higher than the government bond yield for that maturity, the treasury bill yield. Are you following?
Yes, sir.
What? That's a very contrived yes. I think most people are not following, except for Sahil has followed. So TED spread, do you understand? So if we are saying TED is only nothing but treasury euro dollar spread. And euro dollar deposits, okay, and the interest rate on those deposits we refer to as LIBOR, okay. So therefore, the interest rate on euro dollar deposits is reflecting the cost of borrowing, okay, total cost of borrowing for AA rated banks, okay, or generally any other AA rated, because mainly it's banks who are borrowing in the LIBOR market, okay. So that's why we say AA rated banks. but the total cost of LIBOR, suppose 3-month LIBOR is, let's say if we just do it here to make it a little easier for you guys. We don't have the cap, maybe we'll have this here now. The calc file will come up, okay? So we just add one more sheet here. All right, so if the, whatever, let's say 3-month euro-dollar deposit, the yield is, let's say 4.5%, okay? Let's just say, okay, let me just add one, let me just add on, add a sheet. Is it ready now? So let's just call it dead. All right, so it's, let's say the 3-month LIBOR is, I'll make this, okay, so let's say this is 4.5%, okay, and let's say that 3-month bill is let's say 3.75%, okay. So the 10 spread is what is it? Yeah, so the 4.5 minus the 3.75, this is our 10 spread, okay. So what have we done? How did we derive the 10 spread? If you remember, when we were looking at these other credit spread charts here, okay, when we are looking at this BAA credit spread chart, how, remember, this is a direct plot of the spread, okay. 2.3, the current value means BAA. How did they derive this data series? This current value of 2.3 that you're seeing, how did they derive this data series? They looked at the average yield on the BAA bonds, okay. Understand how this series is derived, okay. The average, they looked at the average yield for BAA bonds, and then from that they for 10 years. This is the 10 year, yeah, this is 10 years, okay. So this is a plot of the BAA credit spread, okay. How did they derive this data for this series? They looked at the average yield for 10-year BAA corporate bonds, and then from that they deducted the yield on the 10-year treasury note for each period. Is this clear? That's how they derived it. Okay, so this is what, time series data or cross-sectional data? Time series, right? So they have plotted it over a period of time, that same variable. So that means every day they did this exercise and they plotted the data, and then they just joined the dots and got this line. Okay, so this is the way you derive a credit spread. Sorry?
They use 10-year yields.
Yeah, that's what the data says. That's what the narration says, right? What does it say?
10-year
right? So when they're deriving and spread, that means obviously what they have not mentioned, they have taken the average yield on 10-year corporate bond, but that's obvious. You would not take 5-year corporate bonds and from that you would not deduct 10-year treasuries and derive a credit spread. You have to always work on the same point of the curve. Okay, that you have to be very clear about. Like you can't take an amount in Japanese yen and deduct it from an amount in Indian rupees. Okay, so you have to be on the same point of the curve. Obviously, that's understood. So 10-year corporate bonds minus YTM on 10-year corporate bonds minus YTM on 10-year treasuries.
Yes,
that's how you got the credit spread?
Yes.
Okay, so what did we do here? Did we not do the same thing?
Yes.
What did we do? We took the YTM on 3-month LIBOR, and then we, from 3-month LIBOR, we deducted the YTM on the 3-month treasury bill. So what are we doing? We are taking a non-sovereign cost of debt. We are taking a non-sovereign cost of debt, and from that we are deducting the sovereign cost of debt. That's how we got the credit spread. So that's why I'm saying that now this particular spread is called a TED spread, because one of the legs is a euro-dollar deposit. Is this clear?
Yes.
Okay. So that's why I'm saying a TED. That's why now you understand my statement that a TED spread is a species of credit spread.
Yes.
Is this clear now?
Yes.
We always like to use, I like to, it's kind of, maybe it gets a little hackneyed, but it's important to use this language species and genus, so that you have a very good understanding of, because a lot of the stuff we think we have just taught you and you remembered it and you understood it, but then we find that you've not understood a lot of basic stuff. So there's no harm in rehashing stuff. Okay. All right. So a TED spread is a species of credit spread. Okay. Now, while you're doing TED spreads, it's important as a part of your debt capital markets understanding to bring in the idea of an interest rate swap, although we are supposed to be doing swaps at a later date as a big instrument class, because there are many other categories of swap. Okay, so but let's see if we can get a ideally, let me try and look at. Okay, so what you need to understand is that this euro dollar deposit, this double A credit spread. Okay. Now, typically, because euro dollar deposits are only from, let's say, euro dollar deposits are from 1 month to 12 months. Okay. Now, suppose you want to know what is the double A cost of borrowing, okay, beyond 12 months. Okay. Can you construct a double A credit spread curve beyond 12 months? Because euro dollar deposits are actually only for 1 month to 12 months. Okay, because euro dollar deposits are money market instruments. They are a money market instrument. So what is one of the features of a money market instrument? Initial maturity has to be less than or equal. Actually, we should say less than or equal to. Okay, because you can have 1 year bills. Okay, those are considered as one money market. So less than or equal to, right? So euro dollar deposits, that strict euro dollar deposit curve will stop at 12 months. Okay. Now, what if you need to know what is the equivalent cost of borrowing if I want to go further down the curve, if I want to go to longer maturities like 5 years, 10 years, etc. Okay. Now let's here try to let me try to find out. We have to spend a little bit of time, I think, to try and. Okay, just give me a little bit of time. Let me just detach from this for a while and look for. This is not the. So the question that we are talking about is suppose that what you've done, let's take this example of we are going to discuss an interest rate swap just to give you the understanding of the IRS curve, okay, and what is the meaning of extending this euro dollar deposit yield curve, which runs strictly speaking only from 1 month to 12 months, okay, because the deposits don't run for longer periods. Can you extend this curve and give me AA rated credit cost of borrowing for further out in the curve, like 2 years, 5 years, 10 years, okay? So the answer to that is that when you want to extend the euro dollar deposit yield curve, okay, the correct thing to look at is the interest rate, the IRS curve, okay, the IRS yield curve. So we'll just explain to you. For that, you need to understand what the IRS is, okay? So although IRS should be studied in the swaps module along with, there are many other kinds of swaps, but I'll just give you a brief idea to understand this, and then you'll get a sense of the interest rate risk management aspect as well. Now suppose that, where did we discuss? Now suppose Intel has issued this FRN. Now let's say this is a 10-year FRN, because we're talking about 2016 and this is 2026. This is clear?
Yes, sir.
Okay, so now let me find this interest rate swap part here somewhere. How do we go to full screen? Anyway, it doesn't seem to have that option. I have to go to F11.
Sir?
Yes. Who is it? Okay. Just find out who's standing at the gate. What do they want? Maybe Lakshay, you go. We'll find out what happened.
You have a possible seat, sir. It's outside.
Okay, let him give it to Rajesh. Now just tell him to give it to Rajesh. Okay. We are. Okay, all right. Now let's see where the interest rate swaps are. Okay. So interest rate and currency swaps, page 8. Okay, so let's go to page 8 and see. Very okay, guys. Let's look at this. Let's look at this one example. This example, look at figure 2. Okay, look at figure 2 on page 7. So let me refer to this here. Okay. What is the question is what is the equivalent of the euro dollar deposit yield curve, okay, further for longer maturities? Wait, what is happening? I'm going to deduct 2 marks from your team. You guys are behaving like a bunch of kids. Now we have to move. Have we moved Goyal to your team? Yeah. So this will go to -6. You want some more marks? You can keep on doing that, whatever you're doing. Okay. All right. We are here. All right. So the question is, try to understand this question. Now you've understood what the euro dollar deposit yield curve is, because you have these euro dollar deposits in various currencies which are being fixed every day for different maturities. Okay. You take US dollars, you take Swiss francs, etc., which are being fixed 1 month, 2 months, 3 months. Every day they fix it at 11 a.m. Okay, in London. So now you get those LIBOR rates for 1 month to 12 months. Okay, because these are money market instruments. Now the question is, what if somebody wants to know, essentially what the Intel Treasury is concerned about is they've borrowed through an FRN for 10 years. Okay, so the FRN is linked to 3-month LIBOR. Okay, and they have borrowed with that using that FRN for 10 years. Now they are a little bit concerned that what if 3-month LIBOR starts rising rapidly? Okay, because right now maybe 3-month LIBOR is 1.5%. Okay. But maybe in 2 years' time it might have risen to about 4.5%. So all my cash flow budgeting for my project, which I'm financing with this loan, everything is going to go haywire because my cost of debt is going to shoot up. Okay, so I have a concern there. So I don't want to remain in fixed rate and floating rate debt. If you remember your corporate treasury risk management case, which we did, there was an aspect of that where the Australian dollar loan was in floating rates.
Yes,
Remember, we never got around to discussing that.
Yes,
because I had not had the time to discuss interest rate risk management strategies with you. Okay, so if you look at this, if you want to look at a comprehensive view of interest rate risk management and foreign exchange risk management, you can just cover both the sections of this book. You'll get a very comprehensive overview, and that is pretty comprehensive now, because even now not much has changed in terms of range of instruments. Okay, only one instrument is not covered there. That is a CDS, which is anyway that was not part of foreign exchange or interest. Well, CDS is within interest rates, so that CDS is not covered, credit default swaps. Okay, because at that time in 1993 when I was writing that, there was no active market in CDS. CDS market started only in the late 90s and 2000s. Okay, all right. So is this question clear to you? What is the concern? We are trying to essentially, Intel has borrowed using an FRN at 75 basis points, which is 75 basis points over LIBOR, over 3-month LIBOR, which is the most common floating rate benchmark in international capital markets. Okay, now they are looking for an equivalent kind of rate further down the line because their loan is for 10 years. okay, and they are concerned that floating rates might rise. So what can they do? Okay, so one of the things that they can do, and this will also help us to understand the extension of the euro-dollar deposit yield curve. Okay, further down the for longer maturities. Okay, what is the so the question is, what is the equivalent of the euro-dollar deposit yield curve for longer maturities? Okay, and the answer is, of course, the IRS curve. And we are going to just see what the IRS curve is. IRS stands for interest rate swap. Yes, so the euro-dollar deposit yield curve is the LIBOR rates for all the. So somebody asks you, what is the euro-dollar deposit yield curve? Plot the euro-dollar deposit yield curve for Swiss francs for today. For today, okay, because remember, yield curve is a what kind of chart? Is it a time series chart or a cross-sectional chart?
Cross-sectional.
Who said time series? Somebody here said time series. Any yield curve is always a cross-sectional data chart. Okay, it is a snapshot at a point of time. So if I ask you what is the US Treasury yield curve for last night, you go to the US Treasury yield curve, the US Treasury homepage, and then you find out what the closing rates for last night were for all those different maturities, and then you can join the points and construct the curve. Okay, so therefore, the good question that helps you to clarify your understanding. Euro-dollar deposit yield curve. If I ask you to plot the euro-dollar deposit yield curve for Japanese yen for today, what you're going to do is you're just going to wait till the LIBOR fixing in London today and see what was the Japanese yen euro-dollar deposit for 1 month. What was the rate? What was the rate for 3 months? What was the rate for 9 months? What was the rate for 12 months? And then you join the plots, and that is your euro-dollar deposit yield curve for Japanese yen for today. So for any cross-sectional data chart, you have to essentially show which variable or variables are being plotted. You have to specify that. That's why I said Japanese yen deposits. Okay, not Swiss franc deposits or US dollar, or Japanese yen deposits. You have to specify that, and you have to specify the date on which the snapshot is being taken. The point in time at which the snapshot is being taken. Is this clear?
Yes.
Okay. So as the IRS stands for interest rate swap. The IRS curve is what we need to be aware of, because this is all part of your understanding of debt capital markets. Because the understanding of interest rate swaps, or all kinds of swaps actually, these are these swaps are what I've called capital market swaps, because they are all intimately connected with capital market issuance. Okay. So that's why they are called capital market swaps. So let's look at what is an IRS. Look at the Intel decision problem. Okay. Now look at figure 2. So figure 2 on page 7. Okay. Let's bring back this information from above so we know which one we are talking about. To get a quick look at it. So this is due 2026, is let's make it 10 years. Okay, priced at 75. Now if Intel Treasury prefers fixed rates, refers to lock in a fixed rate for all 10 years. Is this risk management problem clear to everybody? That Intel has just raised money through the debt capital markets by issuing an FRN for 10 years at 75 basis points over LIBOR, but they are not comfortable being exposed to a floating rate, because 3-month LIBOR is going to get fixed every 3 months. So if interest rates start rising after 2-3 years, they might find that they are in hot water. Okay, so they would what they want to do as a risk management problem is they want to lock in this entire cost of borrowing for this loan for 10 years. They want to lock into a fixed rate. Okay, so here what happens is, one of the things they can do, they can do many things, but one of the things they can do, the simplest instrument they can use is an interest rate swap. Okay, so here you replace ABC in Corp with Intel. So figure 2 page 7, which I keep forgetting. Okay. Yes, it is a hedge. This is a hedge. Okay, because what is that going to do? Think about it. What is the definition of a hedging transaction? Yes, Chadda. Chadda has opened his mouth, which is a rare occasion. He normally does not talk. Yes, give him the mic. Let's see if he knows how to use the mic. Yes. So we should make you sit on the first bench more often so that you talk more often. Yes.
Reduce the risk.
Voice has to be coming through the mic.
To reduce the risk.
Anyway, to reduce the risk, yes, you have not expressed it perfectly, but you got the real point of a hedging transaction. 1 minute. The hallmark of a hedging transaction is a transaction which will reduce the overall risk. Okay, the total risk. Okay, it will reduce the total risk of the first transaction on a hedger's book will always reduce the. So if you take this as the first transaction, it will reduce the risk. Is this clear? Okay, so this is the point. So good that you remembered that part. Now, does this meet the criteria? Let's apply that test because Sahil has already jumped to the conclusion that this is a hedging transaction. Okay, when I showed him, refer figure 2, page 7. RMS, you will understand RMS stands for Risk Management Solutions. Okay, this book has been shared with you. Okay, so you can look at it. I'll make it downloadable as well so that you can download this. Okay, now figure 2, page 7. What are we saying? Figure 2, page 7. Look at this. 1 sec. Guys, please be quiet. Now, look at this floating rate lender, figure 2 of page 7. Look at the floating rate lender. This is, let's say, the consortium of banks which has managed their FRN, okay, for Intel. Okay, now what is happening? An ABC, replace ABC with Intel. Okay, they have borrowed money from this. So understand something else. Remember, what was the other characteristic of a hedging transaction? Did it disturb the underlying position?
No, sir.
No, it is sitting on as a parallel transaction. It is shadowing the underlying position book, so you don't disturb the underlying positions. Okay, that is another feature of a hedging transaction. It is sitting on top of the underlying position. Okay, so it's a separate level. So you notice that the first thing. So here, what you have right now is, in fact, maybe we should just. Yeah, so what you have, figure 1 and figure 2, we can see them together. Okay, so look at this, the cash flow. Can you see the labeling there? Cash flow for unhedged exposure. Yes. Okay, so this is the original period where they have taken they have issued the FRN. Okay, so this 6-month LIBOR, let's replace it mentally with 3-month LIBOR, because in our example is 3-month LIBOR. It doesn't really matter. Even 6-month LIBOR is risky because it can keep on changing. What is this transaction you're doing? Is this a hedging transaction? What is this transaction? Then I'll deduct marks for you guys also, because we don't want to see all this activity. No, there is no pen. This is not an exam. Which team is this? So this goes to -2 and 1 sec. -6. What happened here? Okay, now 1 minute, 1 sec. So this time they're on the same team. This team is higher up. This is Gary's team. Oh, Gary's team has opened their account. Okay. All right. Okay. Okay, guys, quiet. Now, where were we? So, figure 1 and 2. All right, figure 1 and 2. So, 6-month LIBOR, replace it mentally with 3-month LIBOR. ABC, replace it with Intel. And the floating rate lender is the consortium that has lent, that has bought their FRN. Okay, normally FRNs will be sold to investors. Okay. This is not a loan actually. It's a debt capital market issue. So it's bought by a bunch of. So let's think of them as the floating rate lenders, the group of investors that has bought the FRN. So here in figure 1, can everyone see figure 1? Yes. Okay. So in figure 1, Intel is exposed to floating rate risk because this loan is going to run for 10 years. And 3-month LIBOR is going to reset every 3 months. So you don't know what the next 3 months, the next quarter's interest rate is going to be. It could be anything, whatever happens to interest rates. Okay. So therefore, they are not happy with this figure 1 situation because they fear that their total interest cost might go up dramatically. So now they want to hedge it. They want to hedge this exposure. Okay. So because anytime you move from, because the other characteristic of hedging is that you end up with certain cash flows. Okay. You end up with certain, whenever you go from uncertain cash flows to certain cash flows, it is a hedging transaction. Are you reducing your risk or not?
Yes, sir.
Okay, whenever you go from uncertain cash flows to certain cash flows, Arihant is not convinced, nor is Bivu. Anytime you go from uncertain, in figure 1 are the cash flows uncertain over 10 years? The debt servicing cost over 10 years, is it uncertain, Vibhu, in figure 1? Is it uncertain or certain? Uncertain, right? Because this floating rate will reset every 3 months. Although we are looking at 6-month LIBOR, we want to change it to 3 months, okay? So let's just read that as 3 months, okay? So it is uncertain because every 3 months it's going to reset. You don't know what it's going to be. So another characteristic of a hedging transaction is anytime you convert from, you change from uncertain cash flows to certain cash flows, you are reducing the risk, okay? Because risk is essentially associated with uncertainty, okay? Alright, so therefore one of the things they can do is this particular transaction will be called an interest rate swap, okay? The second, can everyone see figure 2? Okay, alright, so figure 2, what happens is, now typically most interest, the standard quotation of it, the figure 2, the additional transaction that you see between SCB, okay, and ABC, the additional transaction that you see, that transaction is the interest rate swap. So make sure that you understand what an important instrument to understand, okay? Very high volume of interest rate swap transactions are done all over the world every year. This has almost become a commoditized product, okay, in the interest rate derivative markets, okay? This is a derivative transaction, okay? So the one that you see, the two cash flows that you see, they are swapping cash flows. A swap, why is this called a cash swap? Because a swap means an exchange, okay? I swap my phone with yours, which means you give me your phone, I give you my phone. That's what a swap means, right? So here, interest rate swap, okay, is this clear? Okay, interest rate swap is swapping of cash flows. What is happening is, one party, so ABC, you can see what's happening on the screen, right? Everyone can see what's going on? Okay, now can you see why this acts as a hedge? And what is the net cost of debt for ABC after doing the swap? What is the net cost of debt? Net means including both the underlying position and the hedge position. Okay, so doing the swap, when they do the swap, that's a hedge transaction. Okay, and now this position that they have in the swap, that's a hedge position where they are paying the fixed rate. Okay, so in the language of swaps, we just say paying and receiving. That is automatically meant to refer to the fixed rate. So in the swaps market, no one is going to say we are paying the fixed rate. People will just say we are paying, or they'll just say we are receiving. That is meant to refer to the fixed rate. Okay, so if someone in the swaps market says we are receiving on a swap, that means that they are receiving the fixed rate in the swap. Okay, in the swap there will be two rates. In a simple interest rate, this is called a fixed for floating interest rate swap. Okay, floating to fixed or whatever it is, fixed to floating, floating to fixed, depending on where you were originally. Okay, so in the swaps market, this is called, here what we say is ABC in figure 2 has decided to pay on an IRS. To pay on an IRS, swaps market lingo automatically means that they are paying the fixed rate. Okay, and they are automatically they're paying the fixed rate in a fixed floating IRS. If they're paying the fixed rate in a fixed floating IRS, that means they have to be receiving the floating rate. Okay, just like in a base asset, terms asset, if I'm selling the base asset, automatically that means that I'm buying the they're buying the terms asset, right? So in a fixed for floating interest rate swap, just make sure you understand this transaction. So the transaction that you should study on your own is this. We have explained there are many categories of swaps. So this is the category for the moment that you have to worry about, is this category, okay? Floating to fixed or fixed to floating, that's the same transaction essentially. This is only referring to what is your initial underlying position. Okay, so floating to fixed or fixed to floating IRS. Okay, this transaction you have to make sure you understand. Okay, what happened? Oh, it's already 15 minutes to go. Okay, all right, leave. Okay, so this deal is, please make sure that you arrange this between yourselves. I will only allow one person to leave in a particular session. Okay, you can, if there's some urgency or something, you can leave 15 minutes, maximum 15 minutes before the end of the class. Okay, all right. Okay, so is everyone clear about this transaction now? Have you understood this transaction? You read this from here and make sure you understand. The instrument that we want to understand, it's a category of swap. Okay? You remember your asset classes, markets, instruments framework?
Yes,
It falls under swaps. Okay? And this will fall under the row of under debt. The asset class is debt and the instrument is swap. Okay? So this is an interest rate swap. Okay? It will be in that box. Okay? So there are many other types of interest rate swaps. But at the moment we are just looking at this kind of interest rate swap, the simplest category. So ABC has done a simple IRS, fixed for floating IRS with SCB. Is this clear? So what is the total, after doing the swap, what is the net cost of debt, Guy, for ABC? Tell me what is the net cost of debt for ABC in this chart? 1 minute. Are you Guy?
6.38%.
6.38%. Is everyone clear why that is the net cost of debt?
Yes.
Mittal, wake up. Are you clear why that is the net cost of debt? Is 6 point. Sorry? You didn't hear, but did you hear what Guy said? Okay, good. Okay, Gupta.
Yes, sir.
Gupta means I only call Akshat. Akshat I call Akshat. Okay. No, him I call Rahul. Okay. Just like Siddharth Goyal is called Goyal and Sahil Goyal is called Sahil. Okay. Yes, Gupta.
Yes, sir.
You understood why Guy is saying that the net cost of debt is 6.38%? Not understood.
Can you explain?
I've already explained, now you go and read it, okay? I just wanted to see whether, you make sure that you understand this stuff, okay? This you have to do on your own, okay? You read this since it's recorded, you pre-play it, I don't want to waste more class time because we are not able to move into the options module we are covering. But these are all important things. This is part of your debt capital markets. Very important to understand debt capital markets, how they operate, okay? So this is one of the reasons. So has everyone understood this?
Yes.
You have an idea of what's going on? They are changing from their floating rate liabilities. They are effectively the total cost, the net exposure is all that matters. Once you have done a hedge, you are not concerned with the underlying alone. Okay, you are concerned, and you are not concerned only with the hedge. You are concerned with the aggregate. Okay, hedge position plus underlying position. Okay, so therefore the net position has gone. Now they have achieved their goal. Now if you replace ABC with Intel, can you see that they have locked in a fixed rate of borrowing for 10 years? Is everyone clear about that? They have locked in. So this is one of the simplest ways to manage interest rate risk, and that is to do using a fixed for floating or floating to fixed interest rate swap. Okay. Now the question might arise that the question that would arise is, okay, why did you could logically ask this question? Why did Intel not directly issue fixed rate bonds? You could ask, why bother to go and catch your ear like this? Why not directly go and issue fixed rate bonds? If you are not interested in floating rate debt, why not go directly and issue fixed rate bonds? Is that a valid question?
Yes, sir.
Okay, so the question, the answer to that will give you some idea about debt capital markets and how they operate. Remember that, yes, given the mic.
Please, hello.
Yeah.
Sir, please explain, please throw some light on CDS.
CDS we will not do now because CDS is a totally different category of instruments. 3D is referring to credit default swaps. Okay, so maybe I'll give you some material because we won't have time to refer to credit. One thing you can understand about CDS, a CDS is not a swap in the sense that this is a swap. So that is actually bad terminology. CDS is bad terminology the market has come up with. A CDS is actually not a swap. It's actually a exotic type of option. In this book, you will also find a discussion of. Let me just write this much at least as a thing. You will come across this term very often because this is a big CDS today is a very popular product. Okay, everyone knows what CDS stands for. Credit default swap. That much you should know. Okay, CDS stands for credit default swap. Okay. Have you guys got your textbooks by now?
Yes, sir.
Okay, so even in your textbook, the CDS has not been properly described. It's been described as a doom, as a deep out of the money put option. That is also not fully correct. It's actually a barrier type of option. It's an exotic option. Okay, credit default swap is a is most similar to a barrier put option, okay? If you want to know what a barrier option is, we won't have a barrier option as an exotic option, but it's described in this book where you're seeing the chart of IRS. Okay, so barrier options, you can read up on what barrier options are on your own. Okay, though not exactly the same, but it's actually is most similar to a barrier swap option. A CDS is not a swap. Okay, not a swap as in IRS or FX swap. Okay, the two categories of swaps that we are going to study is basically the capital market swaps such as the IRS and the foreign exchange swap, okay, which is basically nothing but it's just like a repo. It's a intra-market spread. Okay, so these are the two categories. These instruments have been in place for many years, 20-30 years in the financial markets. So when they came up with a new instrument called a CDS in 2000, early 2000, they should not have used the word swap, okay, because the word swap already had a very specific meaning. Okay, so it's bad terminology, but the market does this a lot. So remember that CDS, I'll only tell you this much at this point, and the definition in the book is also not correct. They've called it a deep out of the money put option. It can be made more specific than that. It's actually a barrier put option. Okay, and you can read up on barrier options in this book. Okay, so now point is that this IRS, they've done this IRS and come up with this situation. Everybody's understood this situation. Okay, so essentially now 1 minute. So let's say now Intel is slightly worse than a AA credit because they had to pay 75 basis points over LIBOR. If they were a pure AA credit, they would have paid flat LIBOR. Okay, that's called LIBOR flat when the basis point margin is 0. If you borrow at like these guys are borrowing here, ABC Incorporated is a AA rated credit because they borrowed at LIBOR flat. Are you following what is meant by LIBOR flat? LIBOR flat means there is no interest margin above LIBOR. Exact LIBOR. Fix whatever 6-month LIBOR is, that's all they will pay. That means that they are a AA credit. But Intel has paid 75 basis points over LIBOR, that means they are a worse than AA credit. We don't know exactly what the rating is, but they are worse than AA. Now the question is,
So there can be any other reason also for paying the higher?
no, the only other reason is the credit risk. The only reason is the credit risk. Okay, so that is the pricing of that reflects the pricing of their credit risk for 10 years. Okay, all right. Now what happens is, look at this 6.38, which is called the interest rate swap rate. Okay, so the normally interest rate IRS rates are quoted against 3-month LIBOR. Okay, this transaction is against 6-month LIBOR. So now just look at the IRS rates. So this 6.38 is the IRS rate. So can you see that it is the equivalent? Okay, if you assume that, let's forget the Intel example, if you assume that ABC had borrowed, and we are talking about ABC, so can you see that this 6.38 is like a 10-year LIBOR rate? No, what I'm saying is, assuming that this ABC loan is also for 10 years. Okay, what have I written here? Then there must be some mention of the year maturity here. 5-year. Okay, this is a 5-year example that I've given you. Okay, so here can you see that if they've borrowed for if they've done a 5-year IRS at 6.38%, okay, so can you see that earlier they had borrowed at 6-month LIBOR, now they have converted that into a 5-year interest rate of 6.38%. Can you see that therefore in this case the 6.38 is like the 5-year LIBOR rate?
Yes.
Are you following what I'm saying?
Yes.
Because I've been able to swap my liability pure from flat LIBOR to a 6.38 rate, which means another way of putting this is to say that the 6.38 is like a 5-year LIBOR rate. The 5-year equivalent of LIBOR, because earlier I was borrowing 6-month LIBOR flat and now I just converted it into 6.38 and that's all I had to pay. I might have had to pay 7.5 if that was the rate, but in this case the market rate was 6.38. Is everyone following this point? It is effectively like a 5-year. I was borrowing in LIBOR in the money market. The equivalent rate for LIBOR is for 5 years is 6.38.
Yes.
Okay. So now these interest rate swaps, how did this 6.38 rate come about? How did this 6.38 rate come about? Let's look at the quotation for interest rate swaps. Class is over. Oh, we have still got 3 minutes. We can finish this job 1 minute. You can see how many types of swaps exist. Okay, guys, now let's finish this in 2 minutes. Then you can hear the video. Since it's recorded, you can listen to this. Understand this concept. We were trying to answer this question of what is the equivalent of the euro-dollar deposit yield curve beyond the 12-month period. Is that right? Okay. So then we looked at some 10-year, 5-year interest rate. We see that ABC did a 5-year interest rate swap where they were able to move from 6-month LIBOR to 6.38. Okay, which means for 5 years the equivalent rate for LIBOR, because they were able to swap it, so it's the equivalent rate in the eyes of the market. Are you following? If I am able to take one mobile phone from you and I am giving you one mobile phone of mine, that means those two are the same. Yes. Otherwise, why am I agreeing to exchange? Yes. Okay. So therefore, if I am able to exchange what I did in that swap structure that you saw, I was paying 6.38 and I was receiving LIBOR flat, 6-month LIBOR flat. Okay, that means I'm able to exchange 6-month LIBOR for 6.38. That means the fixed rate equivalent for 5 years of 6-month LIBOR was 6.38. Okay, so that's why we say that the IRS curve, that's why I've written that statement, that the IRS curve essentially IRS curve means nothing but the IRS rates for different maturities. 2-year IRS rate, 5-year IRS rate, plot them and then draw a line to join them. Okay, so the IRS curve will be the extension of the euro-dollar deposit curve, because it exchanges against LIBOR flat. Are you following? Yes. Okay. Now last point, how our IRS is quoted, because it's meant to reflect the credit spread part of it. This is how 5 years, how did you get to 6.38? Okay, this here it may not add up, but it would have been, you look at the treasury yield. IRS prices are also quoted as a spread to treasury, just like debt is priced. Remember we discussed debt pricing for Saudi Arabia? Okay, how do you discuss the debt pricing? As credit spread, not as an absolute rate. I'm willing to pay 310 basis points over treasuries for 30 years, 165 for 10 years, etc. Okay. Similarly, IRS prices are also quoted as a spread to treasuries. You see this pricing? Check this pricing here on page 13. Okay, figure 15 on page 13 of that book. Okay, swap spread. This is how you get the swap rate. You take the treasury yield. If you want to know the 5-year swap rate, you look at the swap spread and you add the swap spread to the treasury yield, and that's how you get the swap rate. No great mystery here, because you have already seen this in the case of corporate debt pricing. Wait for 2 minutes. The important point will cover it. Okay? Is this clear? No new method is being shown to you here, because you have already understood the pricing of corporate debt exactly the same way. Okay? Treasury yield plus the corporate credit spread gives you the total cost of debt. Okay, Ishan is very impatient, but just wait for 2 minutes. We are almost done. Okay, but this is an important point. I want to cover this, and so that next class we'll move straight into options. Okay, so is this point clear to everyone? Okay, so this is just so that's why we are saying, so the IRS curve essentially is the extension of the euro-dollar deposit curve for longer maturity. Maturity is longer than 12 months. Okay, and please remember last minute discussion with Sahil and Gama. Please also. That's also part of your syllabus, okay? If you don't understand, then call me. Okay.